All right. Look, with you here, we might as well kick this off. But before we do that, what I would like to do is an acknowledgement of country. We would like to acknowledge that this is being held on the traditional lands of a variety of proud Aboriginal tribes. That includes the Yugambeh people here in Queensland, in my part of Queensland. We pay our respects to Indigenous elders past, present, and emerging. We recognize that sovereignty was never ceded, and it always was and always will be Aboriginal land. So welcome to our GS webinar on equity investment and acquisitions in digital games. My name is Jens. I'm a GS Director of Industry Member Relations, and in the role, I act as a linchpin between our association and our game development members to see how we can best support them in terms of research, advocacy, and other means. And this is probably a good example of the other means. So a little while back, we released a resource on various forms of investment. As you know, finding funding for games is one of the hardest things to do. So we released this massive spreadsheet that gives you an overview of where to find funding. It includes a flowchart. It includes the opportunity for you to select a business model, where you're at in your production cycle, and so on, to then see what kind of funding you could and should apply for. And so today we're going to explore some of these concepts that this resource touched on in a bit more detail, and that is equity investment and acquisition. And so to that end, I would like to welcome Thomas Russell from Spawn Ventures and Daniel Visser from Wicked Witch Studios. Thomas is a highly experienced corporate financier who has worked on media and tech M&A and fundraising around the globe for over 15 years. So you're in very good hands here. He funded Spawn Ventures in 2019 to identify gaming and esports entrepreneurs and to invest early and join them on a value-creating journey. And believe me, he's done that a lot, and we'll hear about that soon. And Daniel was managing director at Wicked Witch, a studio with a 20+ year history, dating all the way back to the Game Boy Color, which was fully acquired by Keywords Studios in early 2022. So before I start with the questions, just some quick words regarding the format, just the usual stuff. You probably know this. In case you don't, if you haven't done so, please mute yourself unless you're a speaker. And I will ask our guests a range of questions, and I will get you an opportunity to ask some questions afterwards. And so you just put them in the chat here on Zoom or on Twitch, and I'll relay them back to our guests. So monitor those throughout the conversation, and we'll give it some time at the end. So that's pretty much it. Let's kick it off. Thomas, let's start with you, and let's start at some basics. What actually is equity investment?
Well, Jens, can I just say first, just for context? So I do two things. I run an advisory firm helping primarily game developers raising capital and with M&A processes. So that's one side of my job. And the other side is working on the venture fund, also specific for gaming. I did advise Daniel on his transaction with Keywords, which Daniel will talk more about. So that's just my two perspectives, just for the audience. But equity investment is really, you can accept investment into your business in many different shapes and forms. You can have options, you can have different type of debt instruments where investors lend you money. And then obviously if investors invest in equity, they become part owners of your business. And it can be minority, it can be a majority, or as in the case with Daniel, they can go all in and acquire everything, and then you are no longer an equity holder yourself. So that is that's what it is. I mean, you typically, you either issue new shares, which will dilute the current owners to the benefit of a new investor, and the investor will then, inject cash into your business. There is another way, which is very rare, especially in startups and young companies. Is the founders can sell their own shares, but then money will go to the founders and not to the business. And the normal scenario is obviously that you're raising money to the benefit of the business to accelerate your growth or invest in a specific project or similar. So that's the basics of equity investment. It can be done in very many different forms and with many different conditions, but that would be the basic.
Yeah, I mean, let's look into that, I guess, in a bit more detail. And I would assume that some studios might be a bit hesitant about this type of investment, as they feel they, might lose autonomy, like, part of their studio, or they have to give up. I'm not saying that that's, the way it is, but in terms of perception from an outside view, there might be some hesitancy regarding this type of investment. What would you tell them to alleviate this fear?
Well, I think, first of all, it's a fact. If you issue new shares, you get on a new investor, or maybe a group of investors on board, they will want to have a say in terms of the business, and they will be very, they can be very different. Financial investors have, well, they primarily invest, well, everybody does, but they very clearly invest to make a return on their investment. So they will have different incentives, and they will work with you in a certain way. Strategic investors, so investors from within the industry, will have very different incentives. They obviously also want to make money, but they can have other strategic incentives. Maybe they want to extract competence that you have, or they want to pair you up with an existing other studio within their group, and aim to build synergies and something larger out of that. So it can be very different. I mean, if you raise money, you do it for a reason. And it's typically because you need money to fund your growth. And you should think about who you let into your group of investors. You should do your own due diligence, look at what kind of investments they've made previously, talk to them, ask them about why they're doing this, what they want to achieve, and also think about, how, financial investors have, typically, they need some kind of exit plan. There needs to be an event in the future where they get their money back, and hopefully multiples of it. Whereas strategic investors don't, that's not necessary for them. They can buy and hold forever. So you should really do your due diligence, and then in the end, it depends also how much equity you're issuing. If it's 10%, typically they will have a smaller say. If you issue and you go below 50% yourself, then obviously the new investor will be a majority holder and will decide, the future of the business, unless, and all of this can be changed in the transaction documentation and the shareholders agreement. Financial investors, they want something, even if they're minority, they may want certain clauses to protect them and their investment, and give them certain rights, especially when it comes to exits and other transaction events. So yeah, it is what it is, but you're doing it for a reason. And if you do it right, you get an investor that you can work with, because you will work together. You will have a common incentive. So you find one that's right for you. It will give you much more benefit than just the cash, because they can help. They can help you with things based on their experience, based on their reach and their contacts, but also general experience or synergies from other operations. They can help you. Sometimes, everybody's different, but corporate governance, or setting up structures for your company, setting up reporting structures. As you grow, you may need new accounting systems or new incentive plans for your employees and so on. And in many of these cases, they can assist, or at least advise. They probably won't come down and help you code the games, but for all the things around that, some of them may be able to help.
Yeah, I mean, I was about to say, like, finding money to start a business is hard, but growth is hard as well if you don't approach it from the right angle. So I guess there is an additional benefit there if you have the experience and networks that can help you along that path.
Yeah.
Um, you already alluded to some of the expectations that investors might have, and last week when we did the VC webinar, we also heard about the exit. I guess that's somewhat similar with equity investment. Or what are some of the expectations you would have of a studio that you invest in? And I understand there are various motivations to invest that you somewhat alluded to, but maybe we can go into that into a bit more detail into how many multitudes at what time frame and that kind of thing.
Yeah, so it varies, right? Yeah, it varies from investor to investor. So some have longer, some have shorter, but beyond 5 years, it's 5 years is a long time. 5 years is a long time for an investor, but it's also a very long time for the developer. A lot of things change in 5 years. So I would probably not make a plan beyond that. Something needs to happen, and it doesn't have to be, it doesn't always have to be an exit. It can be some other type of event, that a financial or a transaction event. But it's all, and the multiples will also depend. If you invest, if you look at venture investments, you have typically a business model where you invest in many young companies, and when you do that, you don't believe, you want to, but you don't believe that all of them are going to be successful. So the venture capital model is very much built on, let's say if you invest in 20 companies, 10 might fail, 8 might become just normal businesses without the growth that you're looking for. And then if you do it right, 1 or 2 companies will actually become what you were hoping for and give you the exponential growth for your investment. But those two have to from the venture capitalist perspective, those 2 have to compensate for the other 18. So that's why that's how that model works. But that's very early stage. If you invest later stage, you will have bigger investments, and you will be pinpointing much more which investments you actually pick and which ones you choose to support. So yeah, but I mean, private equity it's different from venture capital. It's later typically, and it's bigger. They have a similar model, but the ratios are a bit different. So I'm not sure if that answers your questions, but that's how it works. You need, that's why they can invest in many companies, and because 1 or 2 of them will have to pay for all the other. That's the model. That's at least how I see it.
Yeah, thank you. And again, I'm asking from a perspective of a Australian student that might want to consider various forms of investment, and what the expectations are that go with them, so that they can make an informed choice. Speaking of which, I mean, I would assume that maybe some studios might be concerned that if they accepted some sort of minority investment, that could be a bit difficult later down the road once they enter conversations with some larger investors. Because all of a sudden, it's not just you who needs to have that conversation, but also that entity that made the minority investment there. How do you deal with that? Are there any sort of established ways to go about that? Does it depend on individual cases? Is this, generally speaking, regarded as a problem?
Well, it's not a problem, and it's not very complicated. I look at it like this, 2 separate types of investors, again, strategic and financial. So if you get an investment from a financial investor, so venture capital, private equity, family office, or similar, it's typically not a problem to have a second one or a third one coming in, because and most financial investors even like it, because it reduces risk. It validates their own investment decision. So if you have two venture capitalist firms investing together, they like that too. So, and that's a good scenario. If you have that, you can later accept investment from a large publisher, for example. But once you get into publishers or other, game developers or similar, so strategic investors, you actually, you might block for other future strategic investors. So it's just, you imagine if Embracer comes down to Australia, invest in one of our studios down here, it's highly unlikely that Tencent would join as an investor after that. So if you go with a strategic, just again, think of who it is. This is somebody you can work with and you like, and who share, your strategies and agree with them. I think that's the way to go. But yes, you can always divest to another publisher down the road, but it's unlikely that they would come in alongside someone else. Some of them do, but it's worth thinking about before you do it, because it could limit a little bit your options. Yeah.
So again, a matter of doing research and seeing who's a good fit, and then also consider future collaborations.
Yeah, but that's true regardless.
Yeah, exactly.
Whoever you accept, but if you do, let's take Supercell, for example. They have a very specific strategy. They make certain games, and if they invest, they will have a strategy for you as well, and there's a reason, and they may not want to go into console, for example, for Supercell. I don't know, it needs to fit. But yeah, I think I'm not. You should never say no to only because it's a strategic investor, but you should think about the consequences down the road. So it's a very good question.
Yeah. All right. Speaking of questions, and then by the way, we'll go to Daniel, who's anxiously waiting in the ranks.
Right, everyone wants to hear from Thomas.
We do have a question from
Thomas is the fountain of information.
We do have a question here from Ralph in the chat on Zoom, and he's saying, "Hey, question to Thomas: do you see differences between the general tech startup investment space and the game company startup space?"
Yes. Well, both yes and no. It depends on if you from a financial investor perspective, it's different because but it's really not that different. If you talk to a general venture capital firm, they will have limited knowledge about gaming, but to be fair, they will have limited knowledge about many of the things they invest in as well. They are experts at reading, teasers and information memorandums and learning about an industry quickly to base their investment decision on. They're very, very good at it. But yeah, but I would say there are very few gaming specific venture funds around. I mean, especially in Australia, as far as I know, there's only me looking at this, specialized in gaming. But there's a handful. There's a lot more, but there's a handful about around Europe and in the US. So, I mean, it's game, I don't know if I'm answering the question. I'm trying to think if I am, but you know, it's typically IP. It's not always IP, but it's typically IP. And it's from an investor perspective, you build something that has value and that you can sell one to many. You build one, can sell it to many. And it could be any software really, you know, but then if you're specialized in gaming and you know what's worth something and what's not, apparently that helps. Yeah, I hope I answered the question somewhat.
Alf, did that help? All right, well, maybe mull over it and see if you... Okay. Yes.
Yeah, we can come back to it later. That's oh yeah, Ralph. Yeah, you can follow up later. That's fine.
Okay, fantastic. Dan, you've done the extreme version of equity investment. It's a complete acquisition, which was acquired earlier this year by Keyword Studios. What made you do it?
Right, good question. I'll give you a bit of background, and maybe some other the developers can relate to this. Obviously, it's been a 20-year journey for Wicked Witch, and we started out of my garage. I worked at Melbourne House and Taurus Games and whatever, and then I started in my garage making Game Boy games, coding them in assembler myself, and doing the artwork and not doing a great job of it, and then hiring my mate as an artist and whatever. So we had very humble beginnings, all funded by myself. All funded out of my mortgage and whatnot, and and we were living the indie dream back then. We were just doing our thing, which was more like a club than a business at that point. We had mates. We were working all night. We were playing games. We were drinking beer at our desk. We were kind of enjoying our freedom and doing what we loved, which was making games. Along the way, we work is hard to get. We were trying to create our original IP, trying to create our original games, but we had to pay the bills as well. So we were always between creating original IP and work for hire, always. And a lot of companies probably find themselves in that position. It actually was a bit of a problem for us in a way, because we could never be 100% creating original IP, but we also then never focused 100% on just doing work for hire. We were always trying to straddle both. It was like, we used to call it, we'll do the bread and butter work, which is the work for, and then we'll fund our own projects, and we'll try and have a mega hit and all be rich and, be working on laptops in the Caribbean, drinking drinks that come in coconuts or something. In fact, I have this shirt on that's is purely aspirational for that, because that is still the dream in whatever your dream might be. That was ours, right? So look, as we got bigger and bigger, we're pretty well just scratching and scraping to get projects, and then we were scratching and scraping to make our own games as well. And we made some of our own games, and some of them lost money, some of them made money. Most of the time they lost money. Sometimes they broke even. Sometimes we made a bit of a profit, and we would make a sequel or whatever. This is back again. This is kind of pre-iPhone kind of days. And then we were doing the work for hire stuff. So somewhere along the line, as we got, as these things got bigger and bigger, we got offered at one time, somebody, a work for hire studio in Melbourne. We went in there, we helped them do a few games. I think it was about 9 of us at that time. And we were probably like, 6 programmers and 3 artists or whatever. And I was still coding back then. And we were working for them. And we were working for them so much, and they had like 30 or 40 people, that they basically wanted to acquire us. And they offered us $1 million back then. This is probably, I don't know, 2010 or something like that. And I remember they offered us $1 million. They wanted to buy 51% of us, and they offered us $510,000. At the time, that was a lot of money considering the budgets that we were used to. That probably would have been the purchase of shares off of me, not so much diluting to grow the business. So I could have put that $500,000 probably in my pocket at that point, and we could have become essentially part of that other company. We said no at the time, probably just because we were too bullheaded to care. We thought it was, we were going to get more money somehow, or we were going to have a hit or whatever. Probably, but the main reason was we didn't feel it was a good fit They were really quite corporate and structured, and the people there didn't seem to be having fun and get along with each other. And it was a very different vibe from what we created at Wicked Witch. Wicked Witch, it was a real culture of kind of having fun and playing hard and working hard. And we just weren't ready. I think it was just too early, and we weren't ready. Fast forward a bunch of years, and now we're a fair bit more serious business ourselves. And we're like 30 people, 40 people. We're doing AFL games and NRL games on console. We're doing, licensing some Warhammer IP to make our some original games. And we're making original games as well. We've got clients like Mattel doing some mobile games for them and things like that. So things are kind of stepped up. We're now like our third or fourth office by this stage. And things are we're trying to bridge that gap between having fun and enjoying what we do and living the indie dream, between really becoming quite organized and professional and getting our shit together as well, which we had learned along that journey. And at some point, some people started asking, because you're always pitching for games and trying to get projects started. And at some point, people would say, well, if I'm going to fund $1 million to make this game, how much equity in Wicked Witch would I get for that $1 million? Or to hedge an investor might say, to defer my risk in just one game, how about I get some shares in Wicked Witch and offset my risk? So this conversation kind of just organically started happening. Our response at that time was, no, we're just doing it project by project. Wicked Witch isn't for sale, and that was really just because we didn't know anything about it. We didn't really know how it worked, as Thomas kind of highlighted before. I didn't even know that really at that point. I knew companies got sold. My friend had sold his company to EA. That was Firemint at the time. That was about all Iron Monkeys. I was friends with those guys, and Firemint, I was friends with those guys, and they had been acquired by EA, and they were my friends. And so that was about the extent of my knowledge about it. So this kept happening. And then eventually myself and my friend who was advising us at the time, who still does advise us, we thought, well, maybe there's something, we better kind of be prepared for when this question comes up. I think we were at GDC one year. This was the catalyst. We won like best indie game on the best mobile indie game or something. We won something, and we were there at GDC Play, for any of you that have been there. And this guy knocks on the door and he walks in and he goes, I'm a venture capitalist. I've got $10 million. You guys just won this award. I used to live in Australia. I love Australians. What can you do if I give you $10 million? So it's like, this random dude knocks on your door. And the reality is we didn't really actually have an answer for that question at all. So of course we said, oh yeah, we can do heaps for $10 million. But then it raised a very serious question. That's what would we do if an investor wanted to do that? So we put together a plan. We wrote a business plan. We had done one a bunch of years ago, but I was never too into that kind of formal structured thing, which I probably should have been, because there is value to doing business plans. As I learned later on, they can be quite valuable and helpful. So we did it, and we're like, well, $10 million, we would make a couple of these original games, we would get a couple of licenses, and we would do this, and it would be structured in such a way that we would retain 50% through the investment vehicle, and they would retain 50%, and the IP would be negotiable, but we'd hold on to some IP, and so that's what we did. And that was really that's when we started thinking about what investment could look like for the first time. That didn't, 2 years later, and that deal didn't happen because that guy was either just, full of crap, or something happened and it fell through. You know what it's like. 1 in 20, 1 in 10, 1 in 20 people who claim to want to give you money actually end up doing it for whatever reason. However, it had planted the seed and had kind of started us down that track. I'll try and keep this short, Jens, but I think it's important to kind of tell the story, because people might relate to it at certain parts of the way along. Then we we hired a broker or an agent for the first time. It wasn't Thomas. Thomas was the second agent that we hired. We hired an agent that was part of a legal firm. Actually, we went to a few. We shopped around a little bit, and what it seemed to me, and Thomas can probably confirm, there was these like high-end, I call them agencies, or investment brokers or whatever. And some of them, you walk in the door and they would say, well, if we represent you, you're going to have to give us $500,000. And it's a flat fee and it's $500,000 and we'll raise between 10 and $100 million for you. And that's the way it works. And we were like, see you later. That's not for us. We can absolutely not afford that. You know, and they're in their kind of, you know, pretty schwanky offices in Collins Street, and it became pretty obvious that caliber of a person was not correct. But then we also had like you know, some kind of cowboy guys who were younger than us or whatever, who were like, yeah, we can get money, and they didn't do anything either, so they were too low. So I think it became about finding somebody that kind of was a right fit for us, that had experience. So we went with this company and we learned a lot of things. They weren't successful in the end, but we did get close to a few times. Because they were from like a part of a law firm, part of a law group, and they were like the investment arm of this law group. They had very specific ideas to get investment money out of Asia, right? They were like, we're going to pitch in China, in Malaysia, maybe in Japan, and we're going to get money because there's big money in China right now, and that's what they wanted to do. And they flew us over to China a few times. They got us in front of some people, we had some big fancy meals, and you know, and we got close. But the lessons we learned along the way were, how do you value your business, and what is a business valuation? What is your EBIT? What does EBIT mean? And I think Thomas should probably touch on that a little bit later. And we kind of, and then we found that, you know, we made our teaser information, we made our budget forecasts, we kind of made a bit of an information memorandum kind of company presentation deck, and they helped us with all of that. And they had teams of people that would help with that. You ended up having to do a lot of it yourself, really, by the way, because you know your business better than an external agent knows your business. So yeah, you know, I don't think no one can just come in and do it all for you, because you really need to, they have to be a conduit for you to get, you know, whatever you're doing into business language and into business documents, is the way we saw it, and then go out to, and they coached us as well a little bit on pitching to people. And you know, it would even tell us about the cultural things in China and whatnot. Another lesson we learned during that process was every investor we pitched to wanted something different. And this was a real problem for us. It was something that Thomas and I spoke about when we started. I'll get to that in a moment. But, you know, one of the good things and bad things about Wicked Witch was we did any kind of work. We did virtual reality games. We did real money apps like casino machines. We did console games, sports games. We did mobile games. We did original. We did work for hire. We had this very mixed bag of stuff that we had done and did do. That was good because it meant we could fit to an investor's want. Like there were some Malaysian companies that were right into gambling and really saw us to be, you know, to make gambling machines. It wasn't exactly what we wanted, but that's what they would want. There was another company that really wanted to exploit India, and they had seen we'd had some success with our original games in India, and we'd made a cricket game, and they were like, all right, you know, that you're good for India. Other people wanted console, other people wanted mobile. So what happened was, every time discussion got serious with somebody, we redid our pitch deck. We had to redo all our forecasts and numbers. We had to redo kind of our whole suite of information for everyone. And we did that like 5 or 6 times each time. It became really time consuming and a large, big process. The benefit was we had all these kind of pitch decks and ready for whichever direction we wanted to take the business, I guess, later on. All right, so that was us, what I call dipping our toe. That was us dipping our toe into it, learning learning what some of the language was, being able to present the company in such a way, and getting out, you know, finding out what a good story was, and all these kind of things that, you know, investors, to help you get investment. fast forward to Thomas. I met Thomas here at GCAP. I think it was, wasn't it, Thomas? Or was it in Germany actually? Maybe at Gamescom first.
Gamescom.
Gamescom. It was Gamescom. And we got talking, and kind of, he's a lovely guy, and we became friends, and we had some beers together, and we kind of just talked about business probably for about a year or two, and then. In the background, Wicked Witch had been getting more serious about wanting some investment. We had felt, we were approaching our 20-year anniversary. We had been growing slowly and steadily, but we had never had money. It had all been done out of my personal cash, really, out of my own property investments and whatever the company funded. And there'd be good years, and we'd make a few $100,000, and there'd be bad years, and we would lose like $1 million. And basically, we started to get very sick. We didn't want to be on the same treadmill of struggling to make AFL games and struggling to launch our own things. And all the while, games are getting more expensive, right? We used to make an original game for 50 grand. Then it was 200 grand. Then it was $500,000. And now we're staring down the barrel of like $1 million minimum to be able to make an original game. So we were growing, but, the money we needed was growing faster than we were in a way. So we started to get serious about we need money to sustain our growth or to accelerate our growth, because our growth is going like this. And then we've said to investors, we want to change it going like that to going like this, basically. And here's our plan and so forth. So Thomas did a great thing, and maybe, Thomas can take over a little bit, but we engaged Thomas, and he kind of had a structured process that he took us through. You might want to talk about that, because I think it's really quite valuable, the process, or touching on it, or Thomas, you offering to what you can do for people in this way you did to us. The short story was, we got all our materials together, we refined our pitch, and Thomas guided us through us and advised us all, and we went to market, and we went in front of a bunch of people, and I guess it's fair to say we had kind of a choice between, some equity, all equity, a strategic partner, or a potential VC partner. I'm finally answering your question here again, which is, why did you do it? And so that was a journey we'd been through. So here we were at the end. We basically got to the position where we had a few offers on the table. Thomas, rightly so, from a negotiation point of view, thought it was very important to make sure we're talking to everyone and getting the best deal we could. So, the venture capital ones were often, they were paying you largely in shares and not so much in cash, was what it seemed to be. You would also get shares in their kind of vehicle that they were creating, and you would go along with and you would add to that, and you would go along for the ride on that kind of investment structure that they had. So, to me, that was pretty risky, because these were companies that I didn't know. They were in other countries around the world, and how liquid are these shares? Are these shares going to tank? Are they going to go up? It was all just a bit too unknown and risky to me. The strategic partner side of things was always very appealing to us, because I should underline that whole story. Wicked Witch never made a hell of a lot of money. I'm sure a lot of devs will be in a similar situation. If you're super profitable every year and you've got money pouring in through the door, you probably don't need investment. But if you need to accelerate your growth, then you do need investment. So one big hurdle that we faced was that we never really made that much money, because we were always investing in our own growth. We did a lot of R&D. We built up our own game engine. We made our original titles. We upgraded our PC. We improved the PCs. We improved the office. We invested in more hardware. If there was a few $100,000 left for the end of financial year, we would usually spend it for two reasons. One, to minimize our tax obligation. Two, because we probably needed to upgrade some shit and get things better and get everyone new chairs and fix our engine up and finish that game that was only half done, that would get to market, and there was always stuff to spend the money on. And of course, as much of that could be R&D, we would get some back from the government. So we kind of lived in a way where we would break even or lose money and then use our tax return to kind of continue going. And that was great for us because we didn't pay tax and we could keep investing in growth. And that was how we got up to like 75 employees and had a big office and had all the stuff. Problem is, as soon as an investor, Thomas remembers, as soon as every investor looked at our books, they were like, you got this huge big business with 75 people, and I don't see that you make any money. And we tried to explain to them, well, if we didn't make, an original mobile game each year, and if we didn't upgrade our PCs and get new software, we could probably make $500,000 or $1 million in profit if we had a good year and we were super careful, we could do that. But they didn't want to, that's just us saying that. Showing them your tax return and showing them your financials, that's the truth. So when people were looking at it, they were just like, I don't see any money here. And the way we base our investment, and Thomas can speak more about this, is we're going to give you a multiple of your earnings per year, right? And our earnings was nothing. So basically, people were like, well, you don't make any money, and we do a multiple of what you earn, and that was zero. So 5 times 0 is 0. I'm sorry, that's kind of what you're worth. So circling back to why a strategic investment was much more important to us, because a pure financial one was risky and they weren't really seeing the money there. So we needed someone within the industry that knew Wicked Witch's strengths and what we could do, and that would fit them. So in the end, Tantalus had been acquired by this company. So that de-risked the situation largely for us. We'd worked with Tantalus for many, many years. And so when we were looking at these few people that were interested, it was kind of like a better the devil you know situation. They had been acquired like 9 months or a year before us. So, and we were friends with them and working with them, actually. So it was kind of a really good fit already. And B, we could ask them like, hey, how was it? Were the new owners, were they dicks? Did they, did they change everything? Did things get better or worse working with them and all these things? So the short answer to your question, Jens, is why did we do it? Was because we got a chance to get some money. And myself and the other people that helped me build the company got a payday, and we got some money in our pocket and could pay off our debts and things like that. 2, we could stop the treadmill of struggling all the time, struggling to find projects and struggling to get money because they had a large supply line of projects. Fantastic. And C was for the staff. We wanted better wages, better conditions for everybody, and working on cooler games. And these people, instead of working, a lot of people love working on AFL and love working on Mattel games or Warhammer games, but they were kind of small fry. Okay for Australia, but globally they weren't the big cool titles. And this company had relationships with like 23 of 25 top publishers in the world. So that meant that all the guys and girls at Wicked Witch all of a sudden could take that experience that they'd had and be working on like really, really awesome stuff. So they were the 3 reasons. And that was my long story to cover it.
I love those story. I mean, I just seeing your whole journey towards that and how it leading up to it. Thank you very much for sharing that, and thank you for your honesty as well. And dare I say, those are some very good reasons. Thomas, can you maybe talk a little bit about the process, how this all then took place, and what made a studio like Wicked Witch attractive to a potential investor? So from their perspective.
You are still muted, I think, there, mate.
No, I'm not muted. Well, I think when we started the project, I think I said to you, Dan, it would take 9 to 12 months, and it probably did take just a little over 12.
Yeah, I think it was 14 months.
Yeah,
from day one to getting the money in the bank. Yeah.
But how long it takes will depend on a few things. It will depend on how ready the company is, because a lot of time is spent. It doesn't matter if you're fundraising or if you're looking at an M&A transaction. You will spend a lot of time preparing to go to market, and that's preparing, marketing materials, so teasers and management presentations, but also preparing your financials, making sure everything is in order, making sure everything is understandable, financials, your HR structure, salary structures. Do you have option programs? Do you have other ESOP solutions? All that needs to be understood and easily described. But what you do then is you sit down and you discuss, what kind of process do you want to run? Do you want to run a broad process, talking to many people, which takes a bit longer, but you get to talk to more people, so it can be seen as more likely, or do you want to run a narrow focused process where you talk to maybe 5 potential investors? If you have industry secrets or things you may not want to share, you may only want to talk to 5 people, and then you go. It's a very normal process. You agree on the scope or what type of process, and then you prepare all the documentation. Your investment banker or your agent, as Dan calls it, or your advisor, goes out and does the work for you, especially if it's.
Would you say we had a pretty broad? We chose the broad option. Is that right?
Yes, that's correct.
Yep. We were pretty broad.
Yep. So, well, I think we spoke to about 60 different parties. Yeah. And then then you talk to lots of people, and you try to understand who's interested, and you get more and more. First, an introductory call, share some more information, understand what the investors, what their incentives are, what they're looking for, what's important to them. And then you go into a second call, which is longer, and you spend much more time, and you interact with potential investors on other levels as well, potentially. It could be operational, or and then you get deeper and deeper into the transaction, which means you get offers. Then if assuming the offers are acceptable, you go into due diligence, which essentially is showing everything you have, from all the way from financials to salaries to code, and then you go into the final stage, which is final offers and transaction documentation, so agreements basically, and then you close, and money is transferred and shares are transferred.
And what was it? That final stage that you talked about, from the point where they start due diligence on you, that was like 3 months of the process, right, Thomas?
It was very long.
Yeah.
But it was longer than I expected. So I think that's why my time plan didn't really work out. But but it's it's like you run processes like this. You have a schedule, and you have all these Excel sheets with exactly how it's going to be, but in the end, you will never stick 100% to your process plan, because the buyers who have suddenly they're at DICE, and they don't want to talk to you that week, or they're somewhere else, and so you need to be able to adapt, and you need to be willing to commit the time. It did take lots of time from Daniel, and also from your senior team. So that's important to note. Due diligence in particular can involve, can use up lots of management time.
Thomas was kind of driving the process. He was quite organized. So we had our Wednesday morning calls each week. We would assign tasks to. There was kind of a team of 3. It was me, my business advisor, and Thomas, for the most part, handling that stuff. And then Thomas would go crack the whip and make sure we'd got the things done by the next Wednesday if need be. He was very nice. He was very nice about it, but also insisting that we needed to get our things done. And sometimes that involved going to your accountants and getting them to pull your company financials. I should mention that I thought our business was quite simple and quite small and quite well organized. but a process like that makes you realize the things that you have missed and the things that you don't have actually. So my advice would be to anybody who's going through this process to there will be more than you think, for sure. Probably an orders of magnitude more involved in it than you think.
Excellent. Look, we have about 10 minutes or so for some questions. So I'd like to give the audience an opportunity to ask some, so feel free to put them in the chat here on Zoom or on Twitch. Fire away. I'm sure after hearing that story, there's some things that you're curious about.
We can't see the chat, can we, Jens?
I think you can, but I'll relay it back to you. I'll read it out.
Okay. I can't.
Should someone put something in there? I mean, while we're waiting for people to ask any questions, but just coming back to an earlier question, from Keywords perspective, like what made Wicked Witch attractive for an acquisition? Was it the track record? Was it that you had a team ready? Was it a combination of all of those things? Was it that you fit it really well into an existing structure within that company? What do you reckon? Was a factor in that?
I can tell you what I think was good about Wicked Witch, and then Thomas can tell you what really was, if you like. I knew that we had a strong team, right? That was probably the fundamental part of it. I knew we had a strong team. We could execute projects on tight timelines and tight budgets. That's how we operated for the last 20 years. So I knew that the real value was in what we could do, not so much what we had done or how much money we make, but I guess it sounds a bit corny, but our potential in what we could do. If we partnered with somebody who needed some hard shit to be done, like to remaster Age of Empires, for example, like a 20-year-old game, and make it new on in a short time frame, that we had the veteran skills across the board to do that. So I always felt that was our core strength, and probably our culture as well. We're all pretty good friends. We're all pretty tight. We kind of always would speak about ourselves like we were like a family, really. I mean, a lot of the guys who in the senior team were my friends, but the art director is my mate from high school, business advisor also mate from high school. Like, we went back a long way. A lot of veterans from Melbourne House and Taurus and in the local industry as well. So I think it was just what we could do and the way we worked, I felt was our core strength that would be appealing.
Yeah, excellent. No, that makes good sense. We do have a couple of questions here. Dylan is asking, I wonder if there is a resource you can point to or recommend that helps us prepare for equity investment.
I don't know of any in particular. I kind of used our agents and advisors to learn what we needed. So I don't know if Thomas, if there's any off-the-shelf resources as such.
Other than yourself.
Well, I think I was just going to say, I think it's a good idea to think about it and to plan for it, and not be afraid to talk to people about it. You don't have to use someone like me. You can talk to people and say, at some point we may need investment. Would you be interested to discuss? And just start thinking about it, because then you will get lots of questions. I'm sure, and that's for investment as well as for M&A. I mean, I think it's a good tool to have in your strategic toolbox. Doesn't matter if you just started out or if you're a 75 people company. It's still a strategic tool, one of many, but it could prove to be important. I don't know if there's. I'd say preparing. Yeah, don't worry so much about the financials and all that stuff. Just make sure you, as much as possible, is in order. Nobody expects perfect.
Be organized. I think we always thought we were pretty organized. So that helped, I think. Along the way, we could usually find something if we needed it. We had a pretty good, basically our file structure. Our filing, whether it was financials projects, employee records, agreements with publishers and clients. We had most of that fairly well organized. There are a few holes and a few gaps, but we tried to be on top of it as best we could.
Yeah, it's hard to prepare without actually doing the work. So if you've promised people options, for example, in your company, but there's no documentation, that's one of those things. That's going to be hard to explain, right? Because investors are going to want to see those agreements, let's say. But yeah,
I guess the short answer is no. I'm sorry. There's no real resource, not the one I know of, or Thomas knows of.
Yeah.
Well,
I can also say, yeah.
Sorry, Thomas. There you go.
Yeah, then very quickly, a process like this, that me and Dan went through, it is hard work, and it takes more time than you think, but it can also be lots of fun. You learn a lot.
Yeah, we had a pretty good time. Yeah. And we felt like the business was better for it afterwards anyway, after having just gone through the process, because we could have we could talk to people about it, and we knew how to. Yeah, it was just it was good test. Doing a bit of a kind of like doing a post-mortem on yourself, in a way. That's a good segue into that other question, Jens. If I can probably answer that, the three-part question. Verbally deciding on a deal to due diligence and settlement. I think like the first time they started talking numbers, or we started to get letters of offer, that was like a 2-month process until we went to due diligence with one party, and then that was about 3 months until the settlement, and that was a lot of work. In those final few weeks, I should say, it was like day and night, every day, every night, and weekends to get everything done with Thomas, myself, accountants, lawyers, bookkeepers, and then all the same on their side as well, all working and arguing together in a bit of a frenzy to meet a deadline. Do you have to close out any loans first? Yes, that's a good question. Our offer was, as you know, it was 100% equity for all cash upfront offer. Some of our other offers that had been talked about were like half cash, half equity upfront, and then after a 3 to 5 year period, on some other conditions, is what's called an earnout, and then it would be the remainder cash and remainder equity. The remainder shares and remainder cash at that point. I think the rule of thumb is, if you get the cash up front, you probably take less than what is promised down the road, because there's some risk and uncertainty in that. So we were certainly didn't mind that there was a cash offer. In fact, we saw that as a benefit, and I think the buyer felt that money talks. So if you got cash right up front and you can offer it right up front, then it's just like buying a house or buying a car. You can negotiate better like that. So that offer was made on what they called, correct me if I'm wrong, Thomas, on a zero cash, zero debt basis. And what that meant was you could take out all the money that you had in the bank and take out all the cash and keep that, but there were also no debts that they would take either. So yes, so in our case, iPhone 13 Zin, we had to actually close out the loans first. In fact, a couple of those loans even I moved over to myself personally, because I had funded the business personally myself in a lot of ways. And I like your last question. Finally, did you have to become more or less stringent with the business costs, like flight classes or etc.? No, because we were so stringent. I've never been able to afford to even fly. I could afford to fly first class, but part of being a founder and a business owner, I just couldn't feel, I never justified first class flights, because I would feel like, well, I'd rather give that money as a pay rise to someone who's working really hard instead. And which just wasn't the kind of company that just didn't have that kind of cash. We just didn't have that kind of lifestyle and cash. Everything we did was kind of, stringent already. So part of the acquisition actually was to change that, was so that the executives in future could go in first class and could have company cars and all these things that which traditionally couldn't afford. So that's the answer to that.
So now Dan is riding his magical unicorn to work. The one that
exactly. And I'm still driving my beat up Jeep. Actually, I haven't even bought a nice car yet. It's funny, as you get older, the things you think you want and then the things that you think you need actually change a lot.
That sounds like potential for another webinar. But before we go there, let's go with one more question, because we sort of got to the tail end of this. We do have a question here on Twitch from Hookshot, who is asking, if you're halfway through or 1/4 through a project, is it better to go for a publisher over an investor? Or, are you looking for support now over the ladder?
That's a very good question.
I would say, from a development point of view, I would say if you can get a publisher deal and get an advance on royalties or the funding to finish your game and not give away equity in your business, that you take that option first. I would say, for the project's sake. Who knows what, but for the company's sake, if you want growth and you want to accelerate and you want to do another game and a sequel and whatever, then you might look for a strategic partner and investment. That's my answer to that.
No, that's good.
I don't know if you disagree, Thomas.
No, I don't. It depends on your strategy and the stage you're in. If you can get project funding for an individual project, that could be great. If you want to raise $10 million and build the next blockchain shooter wonder, that could be, but that wouldn't be funded by a publisher in the same way. Then you probably need the financial markets or someone external. So no, I think I agree, Dan. Good answer.
I know we've got a little bit over time. There's one more question here on Zoom. Dan, Thomas, are you okay to answer that? And then we'll call it quits.
Pros and cons for investment?
Yes.
And
what are some of the pros and cons for investment if your studio is profitable?
If your studio is profitable, yeah. Well, I can't really relate to that too much. Is it Tony? Because we'd had some profitable years, but generally we weren't that profitable. All I can imagine is if you're profitable and you're experiencing growth, is that if you want to accelerate that growth. I mean, I guess we were profitable, really. We're just not very, like I said earlier, we were just tracking slow growth. It took us 20 years really to get to, to be a pretty large developer within Australia, and to, maintain a level of profit. But some years we weren't profitable either. So for us, the part of the pro was the financial stability. All I could guess that if you're already profitable, is that you want more profit and you want to accelerate that growth, or move into other markets and things would be my assumption.
Yeah, I get the question. I get the question from sometimes. How much should we raise? And it is essentially the same question, because you should raise what you need. You don't. It happens. It's unusual that people raise money without needing it. They would do it to get a very strategic investor onto their board or onto their cap table. But if you're profitable, you're doing okay, and the money funds your expansion plans or your growth plans, then that's all good. You can keep your equity, not do anything. If there's something you want to do and hire 10 more developers and build something much bigger, potentially you should consider taking on an investor. So it really depends on this, where you are in your development, as well as a company and as a studio. So yeah, but it's not a goal in itself just to raise money, is what I would say.
Okay, Thomas, then I've enjoyed this immensely. Some great stories, some fantastic insights. Thank you so much. This was really, really entertaining. Dan, thank you for the stories, the insight, the honesty. It was fantastic.
I don't mind
thank you
talking
for
about myself. It's my favorite subject, Jens. So anytime.
Yeah, like I said, I might reach out for other webinars. Dad jokes with Dan and other wisdoms, but we'll take that offline.
All right.
Thank you so much. Take care and see you next time.
No
Bye.
worries.
Thanks, everybody.
Everyone. Thank you.
Thank you. See ya.